USA in panic, China bans key exports. The fallout of Trump's trade war, how US auto manufacturers are paying the price. In the world of economics, the principle of cause and effect is unavoidable. Just as individuals tend to retaliate when punished, nations do the same, especially if they possess the economic strength to strike back. The United States has long exercised its influence over global trade, but the recent escalation of tariffs on Chinese imports is proving to be a self-inflicted wound, particularly for the American auto industry. Former President Donald Trump's 10% import tax on Chinese goods, initially framed as a protective measure to bolster U.S. manufacturing, is now having the opposite effect. In response, China has imposed retaliatory tariffs on American-made vehicles, including an additional 10% tariff on U.S. auto exports, effectively raising the total tax on certain heavy-engine vehicles to 25%. This move significantly impacts American car manufacturers like General Motors, Ford, and Mercedes-Benz, which rely on China as a major export market. A miscalculated strategy. The core issue with Trump's approach is that it underestimates China's current economic power. Unlike in the 1990s or even the early 2000s, China has transformed into the world's leading industrial powerhouse, surpassing the U.S. in manufacturing efficiency, automation, and scale. This is particularly evident in the automotive sector, where Chinese companies are at the forefront of electric vehicle production and battery technology. By imposing tariffs on Chinese imports, Trump aimed to reduce reliance on Chinese manufacturing and encourage domestic production. However, this strategy overlooks a crucial reality. The U.S. auto industry is deeply intertwined with global supply chains, many of which depend on China for key components such as batteries, semiconductors, and rare earth materials. As a result, the tariffs are driving up production costs for American automakers, making their vehicles less competitive on the global market. Meanwhile, Chinese automakers continue to expand, offering world-class electric vehicles at significantly lower prices than their Western counterparts. The consequences for U.S. automakers. The financial repercussions for American automakers are already becoming evident. Ford expects its earnings to drop by at least $2 billion in 2025 due to declining exports and rising costs. Ford's stock price dropped 19% last year, reflecting investor concerns over the company's future. American automakers exported over $3 billion worth of vehicles to China in 2024, a market that is now increasingly inaccessible due to retaliatory tariffs. China sold over 22 million vehicles last year, making it the world's largest car market, one that U.S. manufacturers are struggling to compete in. At the same time, Chinese automakers like BYD and NIO are rapidly gaining market share, not just in China but across Europe and Latin America. If American cars are effectively priced out of China's market, Chinese consumers won't even notice. They have plenty of alternatives, including both global brands that manufacture locally and Chinese companies producing high-quality, affordable electric vehicles. The bigger picture, the global shift in auto manufacturing. The U.S. auto industry is facing a major dilemma. Production costs in the U.S. are significantly higher than in China, making it difficult for American companies to remain competitive. China has mastered automation and industrial efficiency, allowing it to manufacture vehicles at lower costs while maintaining high quality. China doesn't rely on gasoline the way the U.S. does, positioning itself as a leader in electric vehicle innovation and battery technology. Trump's tariffs are limiting revenue streams for American automakers, putting them at risk of job losses, reduced production, and declining global relevance. U.S. consumers are the real losers. While automakers are struggling, the real burden ultimately falls on American consumers. Trump's global 25% tariff on steel, announced just days ago, is expected to drive up vehicle prices across the U.S. Here's why. The U.S. imports over $23 billion worth of steel annually. With a 25% tariff, American importers will be forced to pay significantly more for the raw materials needed to build cars. Switching to domestic steel production won't solve the problem. U.S.-made steel is already expensive, and increased demand could push prices even higher. A typical car requires nearly a ton of steel and aluminum, so with higher material costs, vehicle prices could increase by $1,500 or more. Used car prices have already risen by 40%, maintenance and repairs by 30%, and car insurance by 29%, adding further financial strain on American households. The trade war's domino effect. Beyond direct price increases, the broader economic consequences of Trump's tariffs could be far-reaching. If American exports to China continue to decline, it could trigger factory shutdowns and job losses in the auto industry. If Trump reinstates tariffs on Mexico and Canada, American-made cars that rely on parts or assembly from these countries could face even steeper price hikes. If U.S. automakers are forced to focus solely on the domestic market, they may lose their competitive edge internationally, allowing China to dominate the global car industry even further. A losing battle against China. The data is clear. China now accounts for 32% of global vehicle production, while the U.S. contributes just 11%. In less than 4 years, China's car exports have skyrocketed, rising from under 1 million vehicles per year to nearly 5 million. Meanwhile, the U.S. exported just 900,000 cars last year, a number that is expected to drop even further due to tariffs. Trump's fixation on tariffs has failed to account for the broader shifts in the global economy. Rather than expanding U.S. supply chains or investing in future-oriented manufacturing, his policies have simply made American cars more expensive, eroding their competitive edge. The uncertain future of U.S. auto manufacturing. Will American automakers disappear entirely? No, but they will be forced to restructure, focusing more on domestic sales while losing their foothold in critical international markets. China, on the other hand, continues to innovate, offering cutting-edge technology at competitive prices. Companies like BYD are developing AI-powered smart driving systems, ensuring that their vehicles remain not only affordable, but also technologically superior. Meanwhile, Western automakers struggle with rising costs and shrinking global demand, a trend that is likely to accelerate if protectionist trade policies continue. The bottom line: who really pays the price? In any trade war, it's the consumer who ultimately pays the price, whether through higher costs, limited choices, or economic instability. Trump's short-sighted approach to tariffs has placed the U.S. auto industry in an increasingly precarious position, while China is quietly securing its dominance in global vehicle production. The real question is, will the U.S. adapt before it's too late? Or will Trump's economic policies push American automakers further into decline, while China continues its unstoppable rise? One thing is certain: this trade war is far from over. The relationship between the USA and China has always been complex and multifaceted. From trade wars to diplomatic tensions, the two superpowers have navigated a challenging landscape. As China continues to assert its dominance on the global stage, the USA must adapt and strategize to maintain its influence. The future of this relationship will undoubtedly shape the global economy and international politics for years to come. As we look ahead, it's clear that the stakes are higher than ever. The decisions made by both nations will ripple across industries, including the auto sector, affecting not just businesses, but everyday consumers. Will the U.S. find a way to compete effectively, or will it continue to fall behind? Only time will tell, but one thing is certain: the outcome of this economic rivalry will be felt worldwide. Thank you for watching. Don't forget to like, share, and subscribe for more in-depth analysis on global economic trends.